Well, it's like I haven't done this recently then. I forgot what I was doing. How are you both, Joe and Lee?
Fine, thank you,
Really
Mel.
good, Mel.
Good, it's nearly springtime.
Yeah, just
The
around
days-
the corner, not long now.
The days are longer, getting slightly warmer. Well,
Yeah.
so it's all good. And then there's change. We've got the budget coming up next week.
We have.
Indeed.
So there's a lot going on. So thank you to everyone who's joined us today. We would love to know where you are from, so you can put it in the comments box, because I know we have people from the UK and other countries. So the geeky part of me loves to see where everyone is from and any comments that you have. So we're going to start off. Are we starting off with you today, Joe or Lee?
Global mobility, I've got a short section and then we're on into...
Okay, right. So I'm going to take Joe and myself off and we'll pass it over to you.
That is great.
Thanks.
Thank you, Joe. If you can just move over slide 1. Wonderful. And then the next one. Okay, so in this short slot, I'm going to give an update on global mobility. Whilst there's not been any substantial legislative changes recently, I'm going to just cover a few reminders and also some of the things that I'm seeing as well. So the first one's on business travel. And those who have people, employees who travel to the UK from overseas and around the world, you'll have obviously noticed a drop-off during the pandemic, and indeed it's taken a while to build back up. But the evidence is thus far that corporate business travel internationally is on the rise again. So hence we turn to compliance, and we're moving towards the end of the UK tax year. So I wanted to flag these things to any of you out there who haven't looked at business travel or paid much attention to it, because sometimes it can get ignored. So I suppose the starting point with this, just to explain it for those who have not dealt with the area before, when you've got non-resident employees undertaking business visits in the UK, those days are subject to pay as you earn. Now, that applies even when the employee is employed by an overseas business and is paid from an overseas payroll, and indeed whether exempt under a double tax treaty from UK income tax. The pay-as-you-earn obligation applies irrespective, unless the duties are incidental, which is very tightly drawn as where people are doing training and so on in the UK. But otherwise, duties are taxable or subject to pay-as-you-earn, at least in the first instance. And that is unless you've got a short-term business visitors agreement. That's the Appendix 4 agreement, as HMRC call it. And I've put a link in the slides so you can look at that if you've not come across it before. But essentially what that agreement does, it enables you to relax pay as you earn where people are exempt under a double tax treaty for their duties in the UK. Otherwise, you have a pay as you earn obligation. And where this might bite is when you get when you get, there will be one at some point, a pay as you earn audit, for example. HMRC will expect you to have an agreement in place where you've got people who are coming from overseas to work in the UK, even if it's for a couple of days. You still need that agreement in order to relax the pay as you earn agreement. You can apply for NT codes on a one individual basis, but that only applies really if you've got one or two people who are doing it. So if you don't have an agreement, the downside is, even if there's no ultimately tax due in the UK because the individuals, for example, are exempt under a double tax treaty, you would still be potentially assessed to a compliance failure on the pay-as-you-earn front and subject to penalties as well. And it's a pain because, as many of you will know, HMRC can look back at a minimum 4 years for pay-as-you-earn, and indeed 6 years for NIC. And if you've been careless, it can be 6 years and sometimes longer. So to avoid that kind of pitfall, an agreement is always a good thing to get in place. And, because we're coming to the end of the UK tax year, the good thing is that once you get an agreement in place, it will cover you for visits that have happened since 6th of April 2023 last year, i.e. those visits in the tax year. So that link there includes the reporting requirements that are needed for short-term business visitors, but just putting that back on the radar for those people who haven't looked at it for a while, and indeed raising it for those who are not familiar with the short-term business visitors agreement. So that's the Appendix 4. Again, in a similar vein, because we're moving towards the end of the tax year and looking back at, who's been working in the UK within your business from overseas over the last tax year, is the Appendix 8 agreement. So that's really designed for people who don't qualify for the Appendix 4 agreements. Now, those are normally people who come from countries where there is no double tax treaty. Essentially, where there's no double tax treaty, it means you can't include them in the Appendix 4 agreement because they're not exempt from income tax. So what the Appendix 8 agreement does, it allows you to pay the pay-as-you-earn due in respect of the UK duties by the 31st of March following the end of the tax year. That is, the Appendix 4 doesn't apply, so there's no exemption. Therefore, strictly you have to operate pay-as-you-earn. This allows you to relax that obligation and pay the pay-as-you-earn after the year end by the 31st of May. So it's an administrative tool really to help you having to set up a payroll record for somebody who might only be working in the UK for a couple of weeks. So worth looking at those two if you've got business visitors into the UK. Across the industry now, it's clear that HMRC are out there still, as part of their employer compliance checks. And these are one of the things that they will be looking at, especially if you've got, overseas businesses or you've got your parent company is overseas. So that's the Appendix 4 and 8. In a similar vein, one of my pet areas is non-resident directors. It comes up quite a lot in terms of compliance matters, where you've got non-resident directors. That's somebody who sits on your board of your UK company, and you've got directors who come into the UK from overseas to attend those board meetings. Those days are subject to pay-as-you-earn, and again, that applies even if that director's not paid in the UK. For example, they might be paid a global fee via a US parent company or Australian parent company. HMRC will basically seek to carve out a portion of their global remuneration and allocate it to UK pay-as-you-earn. So worth checking who sits on your board. Often it's a surprise to people to realise that they've actually got board members on their board who are overseas, especially if you're a larger company. Some of them might be non-executives, for example. So those days are subject to pay-as-you-earn. And again, if you get an audit, it's the kind of thing that HMRC, and I've seen it, will pick up potentially, and it means looking back, working out what board meetings they attended, settling the pay-as-you-earn that you should have paid, and potentially penalties and interest thereon. So worth checking again before we move to year end, because you can then potentially correct a compliance issue in year if it's indeed happened in this tax year. So moving on then to I haven't finished that previous one. You're very keen today, Joe. Yeah, thank you. I wanted to just mention HMRC operational issues. Now, those who have attended these sessions before will know that I've raised the point around HMRC delays in dealing with NT code applications for expatriate employees, Section 690 directions. So just a brief update to say, whilst it does look like it's getting better, that still appears to be there. I think it was something like last July, HMRC were behind by about 300 days. I think most recently, just before Christmas, they were down to about 200 days in responding to some of these requests. So it is coming down, but people are still experiencing delays. One of the things that I've noticed is that it is inconsistent too. Sometimes we get very quick responses, other times it can take a lot longer. But I think the key message there is if you've got people for whom you need no tax codes, for example, they're going to work overseas, then get these applications in really as far in advance as you can. So the final point on that slide then, employer of record. I wanted to raise that because I know that, through discussions with Mel and others within GPA, that a lot of employers use employer of record companies. Now, for those who have not come across employer of record companies, essentially they are companies which will employ people on your behalf. So let's say you've got somebody who is in Germany working from home, and you're sat in the UK as a UK employer, and as a UK employer you don't have a company or corporate presence in Germany. The employer of record will basically say, well, we'll employ that person on your behalf. We'll put them on our payroll in Germany. We'll give them a German employment contract. We'll essentially be their employer in Germany, although in substance they are still working for you in the UK. So there's been a huge increase in that area, probably naturally since the pandemic, or during and since the pandemic, where we see where we've seen also an increase in globally remote working. So I just wanted to flag it because it's one of the areas that HMRC have said they are looking at from a technical perspective, because there has been concerns raised in the industry about whether those things are compliant from a tax perspective and indeed employment law perspective, but tax obviously is what HMRC are looking at. So just to give you an idea of the kind of concerns if you do have employer of record companies, and by the way, this isn't my view necessarily, it's just those things that have been raised by the industry direct with HMRC. One of them is permanent establishment. For those who haven't come across that before, if I explain it in very simple layman's terms, when a company's sending or employing somebody who's living and working overseas, there's a risk that that country overseas will want to assess corporate tax in respect of that individual's activities. Now, if you're not registered as a company in the overseas country, like in Germany in the example I give, the German authorities have no way of assessing corporate tax because there's no registered entity there. So what they do in these scenarios, and this concept, by the way, applies in most countries across the world, is they will say, well, by virtue of that individual's activities, because of what that individual's doing, the kind of work they're doing in that country, we're going to deem there to be a corporate presence or permanent establishment, as it's known. And that then enables them to levy corporate tax on those activities, require filings, potentially audits in some cases. So that concept applies whether you've got one person or whether you've got 100. And obviously, it's a critical part of the tax rules globally, because if you didn't have that there, it would mean that countries globally generally wouldn't have the ability to assess corporate tax in respect of businesses which are in effect operating in that country. So the reason employer of record companies potentially raise a flag here is because if you then employ somebody locally via a third party company, like an employer of record, you're in effect disguising that employment. You're disguising the fact that the employer in substance is the UK company. Now, that may not be an issue if there's no permanent establishment issue there anyway, or there's no corporate tax going to be triggered. But from what we've seen from tax authorities overseas, that there is concern about tax loss, where if an entity was established in that territory, there would have been the ability to levy corporate tax because there's an employer of record there. There's no visibility because they're employed by the employer of record company, but also then it's more difficult then for them to force registration and levy corporate tax. So tax authorities are looking at that, and the UK is no different in that respect. So just a flag on that front. Another scenario we've seen and has been flagged as well is where, for example, under the EU social security rules, let's say you were employing somebody in Spain and you didn't have a corporate presence in Spain. If that individual was working for less than 25% of their time on an ongoing basis in Spain, then actually the obligation to operate national insurance would be, operate social security would be in the UK. So you'd have to operate national insurance under the EU rules and the Brexit agreement. But if you plonk a employer of record company in Spain and employ the individual via that employer of record company, they will automatically operate Social Security in Spain. So Social Security is being operated in the wrong place. So there are a number of examples like that and anomalies which HMRC are looking at. So I just wanted to flag it, not disparaging employer of record companies, but just to say, if you are or you do have concerns, then it's worth getting your tax advisor to have a look at it and just make sure that it is compliant and there's not something going to bite at some later point. So very briefly then, Joe, thank you. I flagged this a few months ago, but I just wanted to raise it because we're continuing to see some HMRC activity in this area, compliance letters to employers. And this is going to affect those companies who have secondees into the UK from overseas companies. Although you're sat, I take it many of you in UK payroll, where you've got secondees coming into the UK from overseas and they remain employed by a company overseas, legally that is, they've got their contract. It might be the case that as in the employer overseas is continuing to contribute to a non-UK pension. Now, it's quite likely in many circumstances, you're not going to have visibility over that. You're not going to see those contributions. They just go into the plan whilst the individual's on secondment in the UK. Now, I want to flag it because those pensions, because they're not necessarily registered and qualifying from a UK perspective, those employer contributions overseas may be subject to UK tax and pay-as-you-earn. So you could have a pay-as-you-earn obligation on those employer contributions. Now, there is a section in the legislation, section 307, which allows tax-free employer contributions where a scheme is put in place for retirement or for death, which enables many people, enables tax relief to be claimed in many of these cases, and therefore you wouldn't have necessarily pay-as-you-earn obligation. But what we're finding is lots of overseas plans, they provide for other things as well, sometimes disability, sometimes health insurance, sometimes the plans allow you to withdraw early before retirement. And what HMRC are doing is attacking those plans and basically saying they do not qualify for relief under section 307. Therefore, you have a pay-as-you-earn obligation. And again, HMRC can obviously look back to assess retrospective liabilities in some circumstances. So just want to check if you have secondees, whether actually there's a continuation of contributions to a non-UK pension plan. There are some of the options to deal with it as well, if you are in those circumstances. Thank you. That's all from me, Mel, today. And now it's on to Mel.
Thank you, Lee. Thank you very much. Hi, everyone. Good afternoon and welcome. Of course, my role here is just a little summary, really, following on from the employer bulletin, nicely provided to us by HMRC, of course, on the 14th of February, of course, Valentine's Day. So a nice little gift there from HMRC to all those payroll professionals. Just a couple of highlights that they've spotted in there, that we spotted in there. The first one is, of course, yes, we've got the student loans. It was that reminder. We've got around, usually each year, around 500,000 SL1/PGL ones, which will be sent out to employers. So this is where we have it for the first time. So let's say we have an employee who, for example, finished off their qualification, if you like, last year. So it's April, it's every April where we start to take their first student loan deduction. So that's where they're referring to. Okay, it's those newbies, if you like, those new ones. So we're expecting these to come through, of course. It depends on how you pick up this information. Of course, it's going to have a big impact on this. If you're retrieving the notifications electronically, probably most of us are nowadays. I would have thought probably most of us out of that will be through the software. So we download those notifications, our tax codes, etc. But of course, it's the student loans now. If your software is doing that, I'm very much expecting it to also pick up, of course, the correct plan type, the correct plan number that HMRC provided us with. So that's what the reminder is about. We're going to have a number, of course, of SL1s coming through /PGL ones. But to make sure, of course, with those SL1s, we did pick up the correct plan type. If you are downloading these manually, of course, via the business tax account, Nothing wrong with that, it's absolutely fine, but each notification will tell you the plan number as well, so make sure we're picking that correct information up to apply it into the payroll ready for April. Remember, they all have different thresholds. Scotland has a whopping threshold this year, of course, moving into 2024, so just make sure we're selecting the correct one. So a little reminder there on student loans, but of course the big one was about payrolling of benefits in kind of two forms, really, two areas. The first one is just this reminder again, because it's very quickly approaching, isn't it? We've only got a month to go now, just over, and it's the start of the tax year. So it's this reminder about payrolling our benefits if we want to volunteer to payroll our benefits. So this informal payrolling, which has been around for a while, really, again since 2016 when the framework came in. If we miss the deadline, HMRC usually let us, payroll our benefits anyway. Still had to do this P11D at the end of the year with a nil return in theory, but they've always permitted us to do that because it was always seen as the future, wasn't it? We always saw it that way. But of course, last year they stopped that and they're continuing it again this year. So if you want to payroll your benefits from the new tax year, you have up until, of course, the 6th of April to do that. If you are using agents, so maybe you don't process the payroll, maybe you use an agent instead, nothing wrong with that. At the moment, as far as I can see, it's still down to you as the employer to do that registration. I am aware I did form part of a pilot group, which was just trialling, if you like, a beta tester site. So how will it work for agents if we register to payroll our clients' benefits for them? So I know that's already gone through as almost like a trial, as it were, so that HMRC get a little bit of feedback from us. But as far as I'm aware, we're still not able to do this in live. Hopefully it might happen in March, you never know. If not, of course, then it's going to be afterwards, and therefore we're looking at 2025 for that next tax year. So under voluntary payrolling of benefits, the way it still stands at the moment, if you want to do this, it's fine. All you're going to do is tax your employee, all those class 1A benefits that you're providing to your employees. We tax the employee through the payroll throughout the tax year. And then, of course, we get to the end of the tax year. So by the 6th of July, we still submit the P11DB. That's the declaration, that's a summary of the Class 1A National Insurance due. And we still pay that by the 22nd of July. So just those reminders as far as this is concerned. If there are any benefits that weren't payroll, because you don't have to do all of them at the moment under voluntary, you could do like a phased implementation if you want. Just do maybe, private medical in the first year and maybe do company cars, add company cars to that in the following year. And again, you can remove employees from payrolling of benefits as well if you wish. For example, maybe you're on maternity, you want to exclude those, you have the ability to do that with voluntary payrolling of benefits. As far as it's concerned, of course, if you haven't put payroll their benefits, provide them still with a P11D. It's still going to be required for those few, or certainly those particular benefits that you've not payrolled. Remember, if you have payrolled, though, that we still have this obligation. We need to provide the employee with some kind of a statement or a letter. And that's usually done by the 1st of June. Your payslip potentially could be that. If your payslip can show, for example, like a year-to-date value for each benefit that you've payrolled, that could be, so your March payslip basically could be your answer as far as that statement's concerned. But again, just one to bear in mind. So a little reminder there about voluntary payrolling of benefits. But it does move us nicely on to, of course, some of us in the industry have been expecting this for a number of years. Do you feel quite shocked, though, really, when we finally got this announcement on the 16th of January, again, all echoed here in the employer bulletin? So what's the plan? What's their announcement? Well, this voluntary payrolling of benefits, ultimately, they want to make it mandatory. They want to achieve this by the 6th of April 2026. So again, the employer bulletin is echoing that and what we've already heard so far. So it's confirming to us that the 25-26 tax year, according to HMRC, will be the last year that we will submit our P11Ds and P11DBs. They've said in most cases, okay, so there may be such circumstances where they still may permit some form of online submission to them. We shall see as we get closer to the time. So they're saying for the majority of us, that'll be the last year. Therefore, moving forward to 26-27 tax year, all of us will have to payroll of our benefits. So again, if you are doing this as an employer, you still have the option. You could try this if you want to do the voluntary option in the first year, maybe 25-26, just as I said, that phased implementation. Try it out for one tax year before it becomes mandatory. I suspect very much when it does become mandatory, that'll be it for everybody. They will simply say no more P11Ds and we're all live. But the other thing they have said, and again, they've repeated this in the employer bulletin in February, the Class 1A will also go through the payroll. Now that format, that calculation, if you like, is already there. It's already in our system. It's used, at the moment, it's used for termination payments. It was introduced in 2020. And it's where we have, termination redundancy, where you can pay your employees up to £30,000, of course, and anything above that, the employee pays tax on. We've been doing this for years. It's ITEPA. Of course, that tells us this, but this is the national insurance part. Since 2020, the employer has also had to pay national insurance, the Class 1A, through the payroll. So the calculation's there, the format that's required is there. Whether that's what they use come 2026, we shall see, of course. Very much suspect it might be something similar to that. But of course, their bottom line on this, very similar to the other one, which is they feel that this is the easier option. This is about making tax simpler, simplifying tax, and of course, making this quicker and easier for employers. Whether that's true or not is still remains to be seen. I'm absolutely sure of it. But we are expecting further draft legislation on this later on in the year this year, 2024. So we don't know a massive amount other than, kind of what we've read so far as this mandatory requirement is concerned. So look out for that. And of course, we will be picking up on this later on in the year. But a few bits we are aware of, and again, you may be aware of it yourself, but just this little timeline I've kind of looked back on over the last 8 years. And I just mentioned there, of course, the voluntary payrolling of benefits, the framework for that came on board in 2016. And initially we were told there were 3 benefits at that time which couldn't be payrolled: living accommodation loans and vouchers, if we remember. And it was just a year later in 2017 where they permitted vouchers to be payrolled. And they also added in loads of extra data fields via RTI, of course, within our software, where it could hold company car data. Then, of course, a year later, because nobody filled in the company car data, they made those fields mandatory. So if you were payrolling your company cars, you had to put the information into the payroll software, so of course it could be submitted via RTI. But I think that's about it. I don't think we've had many other changes as far as payrolling of benefits are concerned over the last few years, again the last 8 years now. There's still plenty to address. We've got the 2 that still can't be payroll. They're still linked to that official rate of interest. So they're going to have to try and get something in place, because those 2 years will fly by. I'm absolutely sure of it. The other one we've got, which has always been an issue, is the self-assessment. So if you do have employees, maybe they work part-time for you, for example, but if they do self-assessment, maybe they've got a little local DJ or something on a Saturday night, but maybe they do self-assessment. The way their student loans are calculated, it refers to the P60, and the P60 data, if you are payrolling your benefits, shows a higher taxable pay. So we know, of course, in payroll it should be based on NIable pay. So at the moment, this is being addressed by the student loan company. They're contacting the clients that have potentially been affected by this, offering kind of 2 options really: either a refund of the money or to leave the money where it is to pay off, of course, the loan itself. So manageable at the moment under voluntary, but how's that going to work with mandatory? So there's a lot of things that still need to iron out. The big one, of course, I've got a couple of clients who are in this position where they offer benefits to employees who are no longer employees. So how will we deal with that? Because, of course, at the moment, there are options available to us, but how will that work moving forward? So lots of things to consider as far as mandatory is concerned. I've put together a couple of queries. I mean, on the left-hand side is maybe more for us, if you like, as employers, at HMRC, for us, for them to address. So things like, as we said, will there be further software requirement for us? I very much suspect there will be more reporting, because at the moment under voluntary, you just put a value into the payroll. We tick a box to say it's a payroll benefit. The only real data that's going through is for those company cars. So I suspect they will want more reporting on the back of this. So maybe a field for private medical, even things like making good. Do they want to know this data that's currently provided on the P11D? Do they want to see that coming through more? Of course, as we move on to mandatory payrolling of benefits, we shall say communication to employees is the big one for me. The tax code is a real problem area. I think some of us struggle to understand what's going on, but I think your employees will as well. And who's going to deal with that? Is it HMRC? Are they going to send out communication? Or just as we've seen in the past, are they going to push that onto us, i.e. the employer / payroll? Are we going to be the ones responsible to try and explain to our employees what's going on? Potentially universal credits. If we tick this box in our software to say it's a payroll benefit, that excludes it from the assessment as far as universal credits are concerned. But what if we make a mistake? What if we don't tick those boxes? So there's lots of things still outstanding as far as it's concerned. From our point of view, yes, we know there's no more P11Ds. Of course, that's the big thing. But we will have to do some kind of reconciliation here, whether that's February's payroll, if we're a monthly frequency, just to make sure we've got the right cash equivalent value. We have taxed the employee correctly. If there is an adjustment to be made, we can still maybe do that in March. Remember this statement that I've just mentioned again. Is this going to be a requirement from the software provider? Are they going to have to provide, this is what HMRC, are they going to want them to do this? Or will it be down to the employer where we have to simply provide this statement one way, shape or form? There's loads of things to consider as far as the business operations are concerned, all the way from the renewal, if you like, whether it's just private medical that you offer as a benefit, but that renewal period, could it be made in April? If it's, for example, in November, you're going to have to do an adjustment partway through the year, and that communication of all benefit changes coming through, we've got to feed that back into the payroll team. So lots of things to consider as far as this mandatory is concerned. I've just simply put a bullet point here of payroll bureaus. Again, I attended a meeting with some colleagues on Friday about this, and it's a huge area. Again, just the things that we've discussed about communication with our clients, but their employees, of course, as well. Of course, all the way down to costings. You know, how do we cost on this? How do we charge back to our clients? So a huge area, and again, one to look out for over the next couple of years. Of course, keep in touch with GPA. We will no doubt be doing some sessions on this as we learn more about this moving forward. But in the meantime, just a heads up, guys, okay? And I think that's it now. I'm not done too bad, just 2 minutes over there, I think.
Okay. Well, thank you so much. So what do you reckon for the summit? Sorry, I've got summit all in my mind. We've got a summit next week. But what's your thoughts on the budget next week? Do you think there'll be any surprises?
It's an option for them, isn't it? They seem to be messing around with national insurance and have done for the last few years. As far as the tax is concerned, you know, they said to us in 2022 they were going to freeze those. But the problem we've got, Mel, I think if they start to make changes to tax, it's the knock-on effect that may have with Scotland and Wales, because potentially they might just go back to the drawing board and start again for their 2024 tax year. So it's going to be an interesting one. But I think HMRC have already started to issue out their guidance, you know, their updates, etc. So I don't know, we'll see.
Well, I suppose it is an election year.
That's it. That is the big thing. And potentially that could be the last chance to make a change here, we shall see.
Lee, you're on mute.
I was going to say that the Chancellor's hands are really tied, I think. You know, if he does something radical, it will be seen as like a last-ditch attempt to beg for re-election. On the other hand, you know, doing nothing, I think his hands are tied, really, because of the economic position at the moment, generally.
Who would want to be a politician?
Well, try to distribute limited resources amongst people who are never happy.
No.
That's all of us, by the way.
Yeah, I suppose that's a whole nother discussion for another time. Well, thank you so much, Joe and Lee. Really appreciate it. It's good to see so many people on today. We even had Dennis from Bogota join us. So, and I'm so glad that it's nice and warm there, Dennis. So thank you. Yeah. So we'll see you in a month's time. Well, Joe and Lee are both at the summit next week. So I'll see you in person next week, but we'll be back online in about a month's time. So look forward to seeing everyone next month, if not in person, next week. So anything before we go? All good?
Yeah, all good. Yeah, look out for next week, I think, Mel, really, as you say, 6th of March and definitely the 7th of March at the summit.
Yeah. All right, well, take care, everyone. See you soon.
Cheers now. Bye.
Bye.